What if I told you there's a way to ride natural gas prices without ever touching a futures account? Sounds powerful until you learn about the invisible treadmill under your feet. Stick with me to the end, and you'll walk away with a simple, practical checklist to use before you buy any natural gas ETF. First, what is a natural gas ETF? Think of it like a ticket to the natural gas market. Instead of drilling wells or buying stock in gas companies, most of these funds track the price of natural gas itself, usually by holding futures contracts. You buy the fund on a regular stock exchange, just like any other ETF, and its value rises and falls with the market price of natural gas. Here's the key. Most natural gas ETFs don't store tanks of gas somewhere underground. They hold futures, agreements to buy or sell gas at a set price in the future. Those contracts expire, so the fund must roll from one month to the next. Imagine standing on an airport moving walkway that's creeping backward. If the next month futures are priced a bit higher than the current month, every roll is a tiny step back. That price gap is called Contango, and over time, it can quietly erode returns even if spot prices don't move much. Let's make that concrete. Say the front month contract trades at $250 and next month is $260. Rolling means selling the cheaper one and buying the pricier one, about a 10-cent headwind. Do that again and again, and those dimes add up. That's why many investors use natural gas ETFs for short-term moves, not as a long-term set-it-and-forget-it holding. There are different flavors of exposure. Some funds are pure futures trackers. Others buy stocks of companies in the natural gas ecosystem, producers, pipeline operators, or utilities, which can behave differently than the commodity itself. There are also leveraged and inverse funds designed to amplify daily moves or bet against them. These are tools for short, tactical trades. Powerful, yes, but like power tools, they demand skill and attention. So how do you use these funds wisely? Here's your simple blueprint. First, clarify your goal. Are you trading a short-term view, say winter demand, or hedging a bill or business cost? If it's short-term price action, a futures-based ETF might fit. If you want broader industry exposure, look at equity-based ETFs instead. Second, read the fund's methodology. How often does it roll contracts? Which maturities does it hold? The roll strategy is the heart of your potential headwind. Third, check the costs. Expense ratios and other fees matter more than you think when returns can be razor-thin. Fourth, study liquidity. Look at average daily volume and the bid-ask spread, so you're not losing money just entering and exiting. Fifth, manage risk like a pro. Size positions modestly. Use stop-loss or alert levels. Treat leveraged and inverse products as single-day or very short-term tools, not long-term investments. Finally, set expectations. Natural gas is volatile. An ETF can make big moves quickly, and Contango can make flat markets feel like walking uphill. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. Here's the bottom line. Natural gas ETFs are a convenient doorway into a complex market. Understand the treadmill, Contango, before you step on. Choose the right flavor for your goal. Control costs and risk. Do those things, and you'll use these funds as intended, precise tools, not blunt instruments. If you want more clear guides like this, keep watching. There's a lot more to master.